morning. You're listening to Insurance Matchmaking, your path to health, life, and Medicare coverage with Matt Libby Insurance. And now, sharing his knowledge, here's your host, Matt Libby.
All right, good morning. Welcome back to Insurance Matchmaking. I know I've been talking a lot of Medicare stuff lately, and so we're going to talk about health insurance before Medicare and what are your options. And I actually came up with this episode idea after the one I'm going to be the next show. And what I did was asked ChatGPT to give me some ideas for for future shows and give me some talking points there. And I've got a new product I'm going to introduce, but you're going to have to tune in next week to find out about that, because this week's show is going to kind of lead up to that. So as I mentioned, what are we going to do before Medicare? And not everyone goes straight from employer coverage into Medicare. So the big question is, what do I do if I retire early or lose coverage before 65? The good news is you do have options, but you do need to understand them. So kind of one of the things that, if you lose coverage before 65, I've got a group that a few employees I've been working with on one of the local companies that's has like 30 employees, and it's only mandated that they provide coverage if they have 50 equivalent 50 full-time employees. So if they had a bunch of part-time employees, they could still fall into that requirement. The 50 full-time FTE, full-time equivalent employees. I think about again, those acronyms. But this company doesn't, I guess, at least that's so they have notified their employees that, June 30th, their policy is going to end and it's not going to be renewed. So I've had a few people kind of scrambling and, hey, I'm losing coverage at the end of June. So we've got solutions for them. Now, one of the great things there, I say great things, but one of the things that simplifies options there is they are eligible to have a special enrollment for the healthcare marketplace because they're losing that creditable coverage. So it's not the end of the world for them, but they may end up paying more than they were. Some people are finding out they're paying less. It just depends on where your income falls and your family size and all that. So not going to go deep detail on that, or at least not in this segment of the show, but we'll get going here. So obviously, again, you might not have employer coverage anymore, but that is one of the first options, insurance prior to Medicare. And in this case, a lot of times that's not just prior to age 65. If you're on an employer plan, it just makes sense sometimes to stay on that employer plan until you're ready to leave. And we've talked about that in other shows, and we can cover that with you if you think that's your situation. We'd love to talk to you about your Medicare when you're approaching that age, even if you are going to stay on employer coverage, and help you look at those options, because sometimes it doesn't make sense to stay with the employer coverage. So if you're still working, that's usually your best option. COBRA may be available if you leave that employer coverage. And we'll compare those COBRA costs. Generally, they're going to be higher. And I've seen it where they weren't higher, but it was for people who didn't qualify for the tax subsidy that helps you with the marketplace premiums. But generally, even if you're at close to the top of the income level for the Affordable Care Act subsidy, the COBRA plan is usually still going to be more than if you go through the ACA and get the subsidy. But one of the things with that is keeping that plan. COBRA does make sense for people, even though sometimes it's a little more expensive on that monthly premium. But maybe you've got some major health issues have been happening. You've already reached your deductible. You've maybe reached that maximum out of pocket, and that insurance is going to be covering everything. Or it's covering your prescription. You have a weird, I don't say weird, but, sometimes there's certain prescriptions that you're getting assistance for, or your current plan covers, and say affordable is relative, but it's at a cost that you can afford. Whereas if you switch to a marketplace plan, you might have to meet a new deductible before that drug is covered, or it might not be covered on that plan's formulary at all. So sometimes it does make sense to keep the COBRA. And I always tell people, especially sometimes it's one of those, they just need a month, is, go ahead, sign up for the COBRA, and you still have a month. You have that whole month to decide whether you're going to pay for it or not. But if you wait too long, then you can't get it. So you can opt for the COBRA and then never pay for it, and then transition into a marketplace plan. So, but but if you turn it down, then it's not there. So sometimes it makes sense to go ahead and request that, and then maybe change your mind and go another route. Yes, the notes here. Like I said, I just kind of whipped this up this morning. So the talking line, it says here, COBRA is convenient, but not always affordable. In most cases, I say not always, most cases it's not affordable. Now, of course, you've got the marketplace. Like I said, you get the special enrollment if you're losing your employer coverage, but everything's based on income and not your health. And I've said, and I've probably said it on the show here, what makes the Affordable Care Act plans affordable is the tax subsidy. So that plan, and they're very expensive. I've priced for a couple of people this week, and based on their income, and even closer to the higher end of the income, but they're getting like a $2,200 subsidy because the plan costs $2,400. But they're still getting a big subsidy of it, or they're getting $600 subsidy, and so now that $2,200 plan's $1,800 or $1,600. Still very, very high cost, but depending on health, that may be the right plan for you. Unfortunately, if you have any kind of major conditions, and I've mentioned here several times, diabetes, it's a knockout for most plans. I do have. I've talked about the Affordable Choice Plan, and I'm going to be touching on that a bit later in the show too. Is it will take people with diabetes, but there are still limitations. I think I may have talked about that last week or the week before. So you can't always get some of those plans that are ACA alternative. If you got upcoming surgeries, you have a chronic disease, you're had a recent heart attack, or you're being treated for a recent treatment for cancer, you're either going to have to go COBRA or Marketplace if you don't have an employer plan. There's nothing else going to cover you out there. So, we do have, depending on your age, we do have some guaranteed issue hospital indemnity plans, as we talked about with a Medicare Advantage plan. We generally refer to those as copay assistance plans, but that's not full coverage. It might be affordable. It may pay so much, per day if you go in the hospital for something unrelated to your pre-existing condition, because the way those work are, they might be guaranteed issue, but they're still going to take into consideration pre-existing conditions. So you can't just depend on that plan to, I'll get this and I'll cover it. It's like, it'll pay so much for a surgery. I'm having surgery next month. It's not going to cover a surgery that's upcoming. It has to be a surgery that you got a diagnosis after you had the plan. And sometimes if you're going to have something like that within 6 months of getting the plan, they may be double checking with your medical records to make sure that it wasn't a pre-existing condition. So they're not going to cover it. Insurance is in the business to, the insurance companies are in the business to make money, not lose money. And if they can avoid paying out a claim, they're going to. They don't look for ways to pay the claim. They look for ways to not have to pay the claim. And that's a general practice, and we do it too. If we can get a coupon for $1 off a meal combo at the local restaurant, we're going to take that $1 off. Myself, being a military retiree, I'll use that military discount. I don't always ask for it. I do like to ask for it, say at Cracker Barrel. And there's a couple of, basically what it does, if you get the military discount, which is usually about 10%, I use it at Lowe's, it pays the sales tax. So it's kind of like being able to go get things tax-free if you use the military discount. So, but as I say, we all are looking for ways to avoid spending money we don't want to spend. So then again, we have private and supplemental, which I just kind of mentioned with some of those guaranteed issue plans. You have to qualify for those. I just mentioned the hospital accident plans. Accident plans are guaranteed issue. So if you're, and I've got clients who are, they're farmers, and it's like, how much is it going to cost you, and how are you, are you going to have to hire somebody to work if you have a cow pin you up against the stall wall and crack your ribs, or step on your foot and break your ankle? How much work are you going to be able to accomplish? You may have to hire someone to come in and do some of the work until you get healed up. An accident plan, it's not going to pay them. It's not going to pay the doctor. You get hurt, you file that, you get the doctor, the report from the bill from the doctors showing that you were definitely had broken bones, and you submit that as a claim to the accident plan. So that, if you got nothing, at least get an accident plan in place. It's not going to help you have a heart attack, but if you get hurt, it's going to help. And they're very inexpensive. Accident plans are not very expensive. Cancer plans, heart attack plans, those can be expensive. And again, some of those plans, you can get those even if you're diabetic. Even if you've had a heart attack, that doesn't mean you can't have a cancer plan. Or if you've had cancer, doesn't mean you can't get a heart attack and stroke plan. So there are options to help protect you against those catastrophic costs. Because we talk about, insurance is the transfer of risk. I've kind of beat this I don't want to say beat the dead horse on this one. I don't like how health insurance and health care have become synonymous. Insurance is to protect you against the risk. A health care plan pays for those certain costs, those co-pays at the doctor. That's on your health insurance plan, but that's actually your health care coverage. I kind of try to compare it to, again, like with car insurance. Car insurance doesn't pay to change your oil. It doesn't pay for new tires, but it will pay for the paint job when you have a fender bender, because now you're using the insurance. Sometimes when you buy a new car, you get free maintenance with that. So that's a maintenance policy. That's your care policy. So we've kind of combined those into insurance plans, but just because you don't have something that's going to pay for a doctor visit, you could still have something that pays for an emergency room visit. So those are some things to consider. So, so we don't want to, again, like I said, it says here, they're not replacement for major medical, and they're tools. They're not full solutions. Those are some of the things that we need to look at when we're looking at those what are called indemnity plans. And I always say indemnity, it's a big fancy word that means it pays you. Some of those indemnity plans, you can assign the benefits to the provider. Some of them will give you a card that you can use just like you would with a medical card. Now, accident plans typically don't, but there are what we call the fixed benefit plans. A lot of those, if the doctor will take the card and file the claim for you, it works kind of like the same thing with the dental plan. All the dental plans we offer, they're PPOs. You can go to any dentist you want. Doesn't mean that dentist is in network. So a lot of times people will call and see if somebody takes their insurance and, for their dental, and the dentist goes, oh, we have never even heard of that. But then you go to the dentist, you give them a card, and it says, well, call this number to verify coverage. And they call the number and they find out, oh, they actually do take that plan because basically, I hadn't heard this term before. It was when Elijah and I went to Brentwood to the NABIP conference, was talking to an executive with one of the healthcare companies, and they talked about renting a network. And I hadn't heard that term. I understood, that especially with dental plans, they'll utilize certain networks. So it's kind of like they rent that network. They use that network's structure to administer their plans. So they don't have their own network because they're not that big. They're just a small fish in the pond, but that network is a big fish. And so they're part of that network for that plan. So your dentist may take it. I've ran into that. I'm trying to think which plan it was now, but somebody said, my dentist said they'd never heard of that plan. Well, they haven't heard of the plan because they're asking about the company that issued the policy, but the company that has the network is the company that matters. So we're up on the break. I want to, I can kind of finish this. The thing is, with assigning benefits, again, with the dental, you may have to pay a little bit more. It may not cover 100% of cleaning, but it's still going to cover some of the costs. And so a lot of times the dentist will file that for you and say, okay, you still owe this much, and they'll bill you that or have you pay it, while you're there at the office. The other thing is you can pay 100% of the bill and submit the bill to the insurance company for a claim, and they're going to pay what they would have paid a network dentist because they get the discounts with a dentist that's in network. And it's the same thing with these indemnity plans. They're going to pay what they would have paid a network provider, and then the difference, depending on which way it goes, whether it covered more, they're going to send you the difference, or you're going to have to pay the bill of the difference. So we're up at the break, and we'll be right back.
Join Habitat Restore at their pop-up donation event every second Saturday of each month at First National Bank in Sparta. The Habitat team will be there ready to go to receive your donations. So don't miss an opportunity to declutter and make a difference at First National Bank in Sparta with the Habitat Restore pop-up donation event every second Saturday of the month.
This summer, Tri-Light is turning up the excitement with a 10 Gig Days of Summer giveaway. That's 10 days, 10 incredible prize packages, and 10 chances to win big with a new prize featured every day. Winners will be announced on the Tri-Light Facebook page beginning July 7th, with the grand prize winner revealed on July 16th. Don't miss your shot at a summer full of big wins. Visit trilight.net today to learn more.
And now, back to Insurance Matchmaking with Matt Libby Insurance.
All right, and we are back in Insurance Matchmaking. I was talking just before the break about the different indemnity plans and how sometimes you can assign the benefits to the provider, and sometimes you have a card to present, and sometimes it's a matter of you have to pay the bill and then submit the bill for a claim. We talked about the private supplemental options. Now I kind of want to talk about the short-term options. As I mentioned, generally pretty much all the short-term plans are going to be underwritten, and they generally, almost pretty much all of them, they will not take someone who has diabetes. You can have other health conditions, and there may just be some limitations to what it will cover, that you have to have a waiting period. Generally, if you have chronic issues, they're not going to cover. I had a plan, I've talked about the affordable choice, that I had a client, he had type 2 diabetes. He was fine there. They were going to cover him for that, but he also was taking medication for asthma, and they turned him down for that. So you never know what may or may not be something that they're going to accept, but we don't know until we apply. So that's how that goes. So sometimes we can do the application and, hey, don't cancel your other insurance. And that's like I talked about earlier in the show, was about, if you're eligible for COBRA from leaving your employer coverage, is go ahead and say you accept the COBRA, but hold off on paying it. So you've got it there in place, but if you get turned down for the short-term plan or a fixed benefit plan because of some health conditions, you just got to pay the bill, and it's there. But if you just flat out turn it down, and you wait to the last minute to apply for, say, a short-term plan, you wait a couple days to get word back from that, and it's declined, and now it's too late to get your COBRA. So let's make sure that you're covered. Make sure you keep coverage. The other thing is, when you're looking at maybe canceling a plan, make sure you've got all your claims settled before you cancel it. It can be some plans won't pay if you cancel before you file your claim. So be very careful of that. Going uninsured for just a few months. I have a story on that. I had a young man that we were looked at insurance options for him. We were getting ready to do something, and then he got a job offer, and he said, "Oh, I don't need it. I'm going to start this job in 2 weeks." Well, in that 2 weeks, sometime during that 2 weeks, he got, I don't know if it's head-on, but he got hit by a drunk driver, had a traumatic brain injury, was not able to take the job, and had no insurance. And now he has a traumatic brain injury with memory issues and balance issues because of that brain injury. He can't work, can't drive a car. And because of his youth and his education, he's been turned down for disability. So somebody who really should be getting the disability is getting discriminated against, in my opinion, because of what he was able to do before he had the injury. Please don't go without insurance. We joke, wrap yourself up in bubble wrap and don't leave the house. And that's when you cook something on the stove and it catches the bubble wrap on fire, and then you have severe burns. I know I'm just being crazy here, but going without insurance is never advised. I never advise somebody to go without insurance, and not just because I might get paid for you being on that policy. Like I said, take the COBRA, pay for the higher cost of the COBRA that pays me nothing if that's what you need to do. But I will look for ways to save you money and still keep you covered. That's what we help with. But So that's some of those issues with the the short-term plans is sometimes you can't get them. They're a limited time, but they work great for a limited time. They're usually a high deductible. They're not going to cover all those preventive things like getting an annual physical, getting immunizations, mammograms, pap smears, colonoscopies. Those things aren't going to be covered by the short-term plans, at least not fully covered like what we call a qualified health plan does, that like a Marketplace plan, employer plan, COBRA. Those all have to cover those preventive. Medicare also. All those plans have to cover your preventive needs. And then again, when it's a scheduled time. Colonoscopies are one of those things you can't get one every year and have insurance pay for it. It is generally a minimum of 5 years, and I think you still have to be over 50 unless you have family history or something like that, and so you still have to go through a pre-authorization process just to get it covered. So don't just think, I got this insurance, I'm going to go over here and have it done. You may be surprised and be billed for all of it. So, check those things out, especially anything that's major stuff. Double check, make sure your insurance is going to cover it before you try to book the appointment. I mentioned going uninsured for a few months, not a great idea. Choosing based only on premium. I can't talk about that enough. Especially, I've talked about that with the Part D drug plans, but I've seen this year especially, and not to slam Blue Cross, I'm just not a big fan of their e-network, and I understand the reason for doing it. It is a cost-saving thing for that, with basically billed as the exchange network, not their standard network, which is the S network. So when if you're doing your own shopping, don't take Blue Cross just because, everybody takes Blue Cross. It's not that Blue Cross. The Blue Cross e-network, now good news is you are in network here at the hospital, so if you just want insurance, the lowest cost insurance you can get for, hospital coverage, the e-network can work. But if you're going to need to see a specialist or you need to have some outpatient surgery and it's not connected to the hospital, it's probably not going to cover it. So the e-network is not a great fit for everybody else. That's why I generally recommend the S network when it comes to a Blue Cross plan. But as I'm saying, that's because what happens is the equivalent e-network plan to the one that's on the S network is usually about, at least with I think, and maybe the same thing with the silver, but there's about $50 a month difference in premium between an e-network and S network plan, and the only difference between the two plans are the monthly premium and who's in the network. That's the only difference. The plans are exactly the same. The copays are the same. The deductibles are the same. Max out, that's all the same. But the networks is where the big thing comes in. And because you have a smaller network, then they offer you a smaller premium. So you got to be very careful. We've had to help a couple people get different plans already this year because they chose the e-network thinking that made sense. And that happened when the Affordable Care Act first came about. Blue Cross was doing an e-network then too. I think it was e-network. It might have been L network. Which just stands for limited. I wish they used L because it's a little easier to explain that the L network is a limited network. So I kind of wish they'd go back to the E or the L just for that reason, because the letters in the numbers for Blue Cross plans, they actually do mean something. So I do like I like how they number their plans. Cigna drove me nuts because they would call their plan the name by what the deductible was for that plan. And if somebody got cost-sharing allowance, the cost-sharing reduction on silver plans, those silver plans would now reflect what their current deductible is. And they'd have a couple plans that were very similar to each other, but just slightly different in the deductibles. Like once you go to the cost-sharing reduction, it's like, okay, which one is it? Is it this one or this one? And I'd really have to dig in and look at some of the copays and go, oh yeah, that's this one. That's not the one I wanted to go with. Not going to be an issue in 2027, and just kind of, I don't think I've put this out on the show here, but Cigna. The under 65 Cigna healthcare plans from the healthcare marketplace are not going to be available in 2027, and that's not just here in Tennessee. So somebody happens to be listening to this on a YouTube or happens to be driving through town and hear me, Cigna Healthcare will not be on the Affordable Care Act marketplace for 2027. So if you have a Cigna plan, and you should get letters, you may have already gotten a notice in the mail telling you that that's not going to happen next year, but just kind of putting it out there right now to remind people. If you have a Cigna Healthcare plan, you're going to need a new plan for next year. There's nothing to do right now. because that won't give you a special enrollment to change plans because the plan's still in effect. And most people they like the plan. The people that I've responded to me putting that out is they're upset because they like their plan. It's one of those, again, you like your plan, you can keep your plan, unless that plan decides to go away. And that's what's happening with Cigna this coming year. So not a bash on them. Aetna, I think, left. We never had Aetna Marketplace around here in our area, but I think it was last year, maybe the year before, they had dropped out. Humana dropped out several years ago. United Healthcare dropped out for a while, came back in, so we do still have United Healthcare plans in our area. So as far as I know, this coming year, in 2027, the Marketplace plans will be Blue Cross of Tennessee, Ambetter, and United Healthcare. So, and right now, that's what we have here in the Upper Cumberland anyway. We didn't have the Cigna plans here in our area, but East Tennessee, and Oscar. Oscar's in the Middle Tennessee, and I think maybe in the East. Actually, they weren't in the East Tennessee here, but they were mostly, I think, Memphis and in Nashville, and they're planning on expanding. So Oscar may be an option next year for Marketplace plans. We'll see. Not checking the doctor networks. Like I talked about that e-network. People think, they go for the low premium and they get the e-network and then find out their doctor's not in network. Sometimes that can still work. If you only go to the doctor once or twice, you're not going to get that preventive paid for because they're not in network. But say you have to pay $50 or $100 to see that doctor for that one visit, but you're saving $50 a month on your premium, that could still work. But I don't encourage you to do that. Most people don't want to do that, want to make sure their doctor's in network, especially if they are seeing, like I have to go to my provider every 3 months to get my, blood tests and get my refills. So, I probably wouldn't want to be, just cash pay at the doctor because I don't pay anything at the doctor. My insurance covers that. And then not updating the income. That's a biggie. If you don't every fall, because it will automatically re-enroll you in a plan for the following year, but maybe you had a raise, or maybe you made going to make less than you had estimated for the year before. You're going to be paying more for the year. Now you'll get that back at tax time, but most of the time the surprise people get at tax time was, I estimated I was going to earn $20,000 and I made $30,000, and now I'm not getting my refund because I have to pay back this much of my subsidy for my health insurance. So it is important to accurately reflect that income for that year. And then with retirees, don't assume COBRA is the only option. And again, COBRA is not the option if you're over 65. You've got to go on Medicare then, or that's going to be the one to do. So remember, health insurance is not a one-size-fits-all. It's very personal. But we help everyone compare these options at no cost. We'll look at your doctor's prescription and budget. So don't guess. Come see us. And remember, at Matt Libby Insurance, we don't sell you policies. We match you to the plan that fits you. So that's been this episode. Keep listening to Grace 107.7. We'll be back next Saturday at 10 o'clock, and we look forward to speaking with you again then.
You've been listening to Insurance Matchmaking with Matt Libby, your path to health, life, and Medicare coverage with Matt Libby Insurance.